Today's podcast is based on your questions. The questions the listeners to my podcast are leaving us on the podcast app, on the property update app, and the questions that our clients are asking us at Metropole, considering that we're coming out of the coronavirus cocoon, but there's still so much uncertainty about a recession, uncertainty about what's going to happen to property values. So today I'm going to give you my thoughts on what you should be doing as an investor. I don't know you personally, but I'm going to give some general thoughts, and you've got to see how this all fits in with you. Because I know people are concerned because there's lots of forecasts, and the forecasts are so varied and sometimes so vague that it's hard to know what to do. Almost all the forecasts talk about the Australian property market, Australian house prices, but few break it down to capital cities or regions or even definitive areas within those areas. For example, Australian house prices are going to fall, well, they used to say 20%, then 30%, and now they're probably saying it may only be 5 to 10%. But what's Australian house prices? Is it the median, which by the way isn't the same as the average? That's just describing a statistic, and it really doesn't differentiate the different sorts of properties: apartments, houses, locations, renovated properties, doer-uppers. So I believe certain properties are still going to have prices decline. That's already showing, particularly the inner city apartment market, the house and land packages, the off-the-plan type properties, where there's an abundance of supply and not many people wanting them. On the other hand, there are some market segments that are doing very well at the moment, that are performing strongly. They're in short supply, and there are people who are looking for those sort of properties. So there's no national housing market. There's not even a capital city market or even a regional town market. There's lots of little subsets, and they each offer different opportunities or risks. So let's have a talk about what's likely to be ahead moving forward. And at the end of this, I hope you can have a little bit more clarity and direction. So welcome to this week's episode of the Michael Yardney podcast.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's most trusted property commentator, who has once again been voted Australia's leading property investment advisor. That's the fifth time he's won a similar award in the last 7 years.
As I mentioned in the introduction, today we're going to have a chat about the recession that we're slipping into, unemployment figures, the cliff that we're going to fall off or not in September, all the common questions that people are asking my team at Metropole and leaving for us on my property update website. Now, I'm not going to do it in a question and answer format because I've actually lumped them all together, and sure, we're going to discuss a few things that you've heard before. We've already spoken about coronavirus and the recession and the property markets, but there's lots of new information in today's session as well. And then afterwards, I'm going to have a chat with Tom Corley, my good friend from the United States, about a blog that he wrote that surprised me, that shocked me, that probably will surprise you as well. But if you understand the message from that, that will help you develop more rich habits and fewer poor habits, which is what my conversations with Tom are about. But back to the property first part of today's show, we're going to talk about some things that, as I said, you may have heard parts of this before, but bear with me because the lessons are important, because we've been hit with a health crisis that has now led us into the most serious global recession in almost a century. And despite living in one of the richest countries in the world, many Australians are currently struggling financially. And if history repeats itself, and I think it's going to, the gap between the wealthy and the average Australian is only going to get wider. So why I'm discussing these concepts with you today is to help you not be a casualty of the downturn and in fact take advantage of the opportunities that are going to rise, because there's still good news out there. You see, even though the recent events have left many of us feeling uncertain. These same events are going to be responsible for some of the best opportunities in our lifetime and may give you the opportunity to set yourself up for lifetime wealth as well, because we are in a time of change. The problem is, though, that most people don't like change. We prefer a predictable environment. But if you can get past that, if you're able to take advantage of the opportunities that are going to arise that are already there, that's what I'm going to talk about today. Now, before you say, hey, Michael, what's this thing about taking advantage of things? I'm not talking about taking advantage of people. I'm suggesting there are going to be opportunities for those who set themselves up for that, and for those who are panicking and those who are just treading water and not going to do anything. Time's going to pass them by, and in due course, as life gets back to normal, they're going to have actually fallen behind because they haven't set themselves up for the new world ahead. See, there's no secret that we're falling into a recession, but what is it going to mean for you, your jobs, your finances, the value of your home, the value of your investment properties? I'm going to discuss each of those things with you, and I'm also going to give you some specific recommendations of what I believe you should be doing, depending upon your circumstances. It'll give you a better understanding of what's ahead. It'll put you in a better position, as I was suggesting, to thrive, not just get through this difficult time. Now, I've lived through quite a number of property cycles. I first started investing in the early 1970s. I've lived through many, many economic shocks, and I have learned lessons from them in the past. I've recognised that there are always periods of significant opportunities. I've noticed that's when great new industries come out. There's a change of the way people do things, the way businesses operate, the way investors think, and there's a transfer of wealth. Look, that's just the way the economy works, so don't fight it. Now, we've discussed in previous podcasts before, but excuse me if I mention it again, that a recession, the technical definition of a recession, is 2 quarters of negative GDP, the economic growth of the country, gross domestic product, what we're actually producing, spending. And while we may not be there yet, we've only had 1 quarter. Remember, in June, the first quarter of the year's results were announced. That's 3 months after the fact. And we're now almost at the end, depends when you're listening to this, of the June quarter. We're over it. The answer is April, May, June results are not going to be announced till September. So we won't know that we're officially in a recession until, in my opinion, we're going to be well over it. But if you think about what's happening right now, there's falling consumption, even though it's now starting to pick up because the lockdown's been released. There's high unemployment, and that's a recessionary issue. How high is the unemployment? Well, recently it was announced that it was 7.1%. But if you have a look at the real unemployment figures, in other words, people who are actually dropped out of the workforce, the participation rates drop. People just aren't bothering looking for jobs. And if you're looking at partially employed people, people on not working full time, and boy, if you add the JobKeeper numbers, our economy's really having a difficult time, isn't it? At the same time, there's been collapsing retail sales. Combination of things. I mean, customers just can't go out there and spend, and at the same time, shops have had to close down. And there's declining small business income. So all these things are making us recessionary, even if we may not officially be in a recession. Hey, don't get too down on all this, because I'm going to explain to you what's ahead, and I think it's over the worst of it already. So let's agree with a recession that's been caused in part by the lack of consumer spending. For a number of months, Australians haven't been able to get out into the shops. We haven't been able to splash our cash. But now that the restrictions are easing, it's likely that more of us are going to be spending. But a lot of us are still going to be cautious. We're going to stash our cash, waiting for news that we're over the worst of things. So I don't see a quick rebound in our economic conditions. You know how some people are saying we're going to have a V-shaped recovery, a deep down and a quick up. I think it's going to be more staircase, a staggered moving up, because some of the shops are opening, some are not able to. Some of the restaurants can take some patrons, but not a full complement. Some pubs are able to open, but only a certain amount. And it's not really going to get back to normal, our economy, until the international borders open up, not just the state borders. So I see an improvement happening. I'm sure that the third quarter, in other words, July, August, September, which isn't going to be reported until the end of the year, I believe the third quarter of 2020 is going to be much better. There's already signs that it's happening. So this recession is going to be different to others that have been experienced. Now, please bear with me if you're not that much into economics, because I will bring it back to what's going to be happening to our property markets. But if you want to become successful, whether it's in property, in any sort of investment, or in business or your own profession, you have to be a student of economics. You don't have to be an economist, but you've also got to be careful who you listen to, because there's all those negative Nellies out there telling us we're going to fall into a deep depression. Interestingly, the Reserve Bank and the economists of all the big banks, the economists I respect, have already changed their forecasts moving forward, suggesting that the downturn is going to be steep in this second quarter of 2020, but the upturn is going to be with us much sooner than many had expected, because fortunately we're already moving out of the worst of the lockdown and COVID. So why this recession is going to be different is because under normal conditions, recessions usually come after a period of substantial growth, after a period of speculation, after a period of excess. You know how property booms, everybody gets in and they buy all the dud properties and they overpay. Same with share booms. So recessions have usually occurred because of after periods of excess and inflation, the government slows things down, the Reserve Bank slows things down, puts a brake on the economy by raising interest rates. This time round, the government has, and I think rightly so, sacrificed economic activity in the name of a health response to the COVID crisis. Of course, we're not alone in this. You know yourself that the major world economies have done the same, and many of them in much, much worse condition than we are. But an unfortunate victim of the government's response has been the almost 30-year run in our economic growth. But we're not alone in this. As I said, other countries are having similar issues as well. So again, how's this going to be different? Well, it's going to be different because the crisis wasn't the result of a bust after a boom. As I said, it was an enforced shutdown, a significant disruption, but it wasn't caused by a fundamental issue with the Australian economy. So because of this, it's likely that once we get more and more out of this lockdown, we're going to recover much more quickly than in previous downturns. But as I said, not a quick upturn like after the global financial crisis, where China's requirement for our minerals pushed us up into a very quick V-shaped recovery. No, this will be more staggered. But there's some other reasons I believe we're going to have a shorter downturn, and I'm telling you this because you are going to still be getting negative messages in the news for a while. Because remember, until September, there's not going to be the official recession, so there's going to be high unemployment figures and people telling us how difficult life is going to be. Now, I'm not suggesting this recession is not going to be as deep as others. It's going to be deeper. But I also believe that in the third quarter of the year, as I keep saying, we're going to be out of the recession because we entered it with the balance of trade positive for Australia and an almost balanced budget. Remember how Josh Frydenberg was so proud of that? And it was also at a time when our banking system was solid. Further, our government, and in fact governments around the world, have learned from the past, particularly from the global financial crisis. They stepped in early, maybe a week or two too late, but they stepped in quickly and early with unprecedented relief packages for businesses, for people, to minimise the downside and build that proverbial bridge across to good times. And I believe they've done a pretty good job. At the same time, the government's provided financial support programs and encouraged the banks to offer mortgage deferrals. The Reserve Bank's lending the money at very, very cheap rates. And what this means is that we're unlikely to see many mortgagee sales that maybe would have otherwise destabilised our property markets. And at the same time, the government's given commercial and residential tenants support packages and programs to minimise the downside. I've never, ever, no, not just me, no one's seen such level of support. Now, some people say, yeah, but it's all going to stop in September. We're going to fall off the cliff. How often have you heard people say that? In my opinion, the government has invested too much time, effort, money, emotion, and publicity to allow us to fall off the cliff in September. The banking system doesn't want to take over your house and be a mortgagee in possession. The banks don't want you to default on your loan. So I can see they're already talking about it, that they're going to actually give people an ability to still pay interest only rather than push them to principal and interest. I know people are worried that they're going to be forced into principal and interest, but the bank would rather you pay something than run into default. Similarly, only recently we're seeing that a lot of people are already pausing their holiday of mortgage payments. In other words, they're now stopping those holidays of not having to pay their mortgages and starting to repay their mortgages. Recently, the ANZ Bank announced that a third of their customers who took mortgage deferrals, holidays, are actually back to paying their mortgages again. So there's confidence happening in the community. It's also at a time when our banking system was in good condition. They came into this crisis well capitalised. There hasn't been a shortage of money or the type of liquidity problems that we've seen in previous downturns. And the other thing, despite what some of the headline-seeking negative Nellies are saying, the quality of credit around Australia over the last couple of years has been very high, with only those who could prove they could service a loan having access to the loans. And that's part of the reason we haven't seen many mortgage defaults or much mortgage stress. Now, sure, there are some first-home buyers who overextended themselves and some beginning investors who borrowed too much to buy the wrong type of property in the wrong location. But in general, debt is in the hands of those who can afford it. The other good thing about how we came into this downturn is that rather than entering the downturn in a property boom, which normally precedes a downturn, for much of the last couple of years, prior to the challenging times now, our property markets were suppressed because of the concerns about the tax issues leading up to the federal election in 2019. And the other thing is our property markets haven't got the significant oversupply that normally occurs when we go into a downturn, because it's the end of a building boom normally. Remember, hasn't happened this time around. Sure, there's a few high-rise towers sitting in the capital cities empty without people wanting to buy off the plan and without tenants wanting to move into those. If you've heard me before, I've mentioned they're going to be the slums of the future. But in general, we've entered this downturn at a time when building approvals and the pipeline for new construction is low, which means there's going to be a shortage of supply for the demand that we've got. Supply's not going to keep up with demand. So I believe it'll be a deep but short downturn. And by the time you're listening to this, we're almost over it. So what's going to happen as we move through the balance of the year? What are we going to experience? Well, we're not over everything. In other words, we're still going to have high unemployment. It's actually going to get higher. It's going to be hard for people to switch jobs. It's going to be reasonable to expect we're still going to get some redundancies and some terminations despite JobKeeper. This also is going to lead to a loss of income and falling wages, which means that there's not going to be as much spending power for Australians, and as I've already mentioned, others are just going to be a bit concerned, so they're not going to spend. So I can't see the retail recovery improving really quickly. I think retailers are going to have a hard time. Many of them are going to be stuck with inventory for autumn, which they haven't been able to move. You know, the clothing shops and places like that, and they're already getting their winter inventory, so there's going to be lots of sales. Now, compounding that, even those who are holding onto their jobs, as I said, the uncertainty, the worry about the future, the worry about their income, that they're worried about employment prospects, that's going to impact their spending pattern and how much people are willing to part with things beyond the essentials. So I can't see a big retail boom, even though I'm really happy as I go out in the streets now. I'm seeing people in the restaurants, people in the shops, but they're not back to the levels they were before. And back to property in the real estate market, it's been very resilient so far, hasn't it? But remember, there isn't one property market. So when people say the Australian property market's going to drop 10%, 15%, 20%, remember way back people were saying 30% or so. They've all gone because the worst case scenarios haven't occurred. But there isn't one Australian property market. There isn't a Sydney property market. There isn't a Melbourne property market. So which bit of the market's going to drop 10%? I can tell you that there's a shortage of well-located homes and investment-grade properties, and they're holding their own pretty well. There's B-grade properties that have dropped in value 10-15%, and the C-grade properties, no one's wanting to buy those at all. So there's definitely a fall in value of those off-the-plan properties, house and land packages, apartments in big blocks. On that basis, if you aggregate them all, yes, the property market's going to slump further. Having said that, we've got working on really low property transaction numbers. There's fewer buyers at the moment. Some are having difficulty getting finance. I know at Metropole we've got lots of investors who want to get into the market now, take advantage of that, but it's taking them much, much longer to get their finance, and there's clearly fewer sellers out there. So there are still more buyers for those good properties than there are sellers. So it really is a seller's market, and auction clearance rates are solid and they're holding up at the moment. So while some properties are going to drop in value further, others are not, but you're still going to get the headlines of property prices dropping more. And overall, they will. But we're not buying the property market. You're not buying the Sydney property market or the Brisbane property market. You're buying a particular property. Well, I don't know if you're buying anything, but my recommendation is if you're in the right position to do so, you should buy an investment grade property in a location that's underpinned by all the fundamentals that we've spoken about on so many different podcasts, at the right sort of price, and in an area where there's lots of owner-occupiers who are affluent and who've got income, who are not going to suddenly sell up their properties and make the value of your property drop. I don't want to talk too much today about how to buy and what to buy. I'll give you some recommendations later on. But the rental market's going to suffer at the moment also. So what's happening moving forward is, especially in a CBD, the high-rise towers, which were never investment-grade locations anyway, there's actually very high vacancies, and in general there are more vacancies around, which means rental growth will be minimal, if at all, this year. In fact, rents are dropping, particularly in the big capital cities of Melbourne and Sydney. Now, before you get too down on this, is there any upside? Well, yes, there is. Again, I believe that those people who see the glass half full, those people who look for opportunities rather than for reasons not to do things, are the ones that are going to do well in any market. So there's going to be opportunities for investors who are prepared to take a long-term view. Interest rates are going to remain at historic lows. The official cash rate sitting at an all-time low of 0.25%, but you can get good bank loans. I've refinanced a lot of my loans at amazing rates fixed for 3 years. It's going to mean it's cheaper than ever to service a mortgage. Now, by the way, that wasn't a recommendation that you should lock in your interest rates. I have a very, very large loan portfolio, so some of it's fixed and some of it's flexible, and I know all the right questions to ask about when to fix and how much to fix and over what periods of time. Hey, that's the topic of another podcast. But I also see the fact that many people are sitting on the sidelines at the moment, a good opportunity, a short-term window of opportunity for people who are looking to get into property, even though if you're looking for a bargain, it's over. If you're looking for an opportunity where there's not other people looking, hey, there's more buyers looking for the right sort of properties at the moment than there are properties. So don't try and time the market. Don't look for a bargain. If you find the right property that suits your criteria, much more important to get in than to try and get a quick one-off hit. So I don't believe we're going to fall off a cliff in September, because I know some people are waiting and saying, hey, I'm going to wait till September, I'm going to buy my property then. I also know that there are some sellers putting their properties on the market now because they're worried about what's happening. But as I said, I don't think the government's going to allow us to fall off that proverbial cliff. As I said, they've spent too much time, money and effort to let the support mechanisms fail. You see, the government recognises the importance of consumer confidence in getting the economy going again. They recognise that consumers aren't confident in their jobs, in their finance, in the value of their home. They're not going to go out and spend, and the government's keen for the economy to be moving, because they can only do so much spending themselves on infrastructure and putting money in our pockets. They need us to spend that money, not stash our cash. So the government knows one thing that holds the 25.5 million Australians together we've got in common is that we live in residential real estate. And it also knows the importance of creating an environment which gives people confidence in the stability of the value of their homes. For 70% of Australian households, their home is the most valuable asset they own. There's no bigger common denominator to stimulate the nation's psyche, to make us feel more confident than supporting our property markets. The government's not going to let the property markets fall. Now, interestingly, that often starts with assisting first home buyers get into the market, because the government knows that there's lots of spin-off. When a first home owner buys a home, they often buy curtains and carpets and TVs and new furniture. The octopus has got lots of tentacles going out, stimulating lots of other areas. So there already has been the job builder scheme, and there are various state-based assistances for first home buyers. Don't be surprised if more incentives come out for them. So what's Australia going to look like coming out of this coronavirus cocoon? I think all levels of government are going to turn their policies to crank up our economy again, to get us spending, to incentivise us. And there is at the same time a pent-up demand for goods and services, including property. Our government's going to be lumbered with a significant amount of debt, but I don't think it's going to be trying to chase that up in the short term by changing tax policies, and the Reserve Bank's not going to be fussed too much with that 2 to 3% band. It's wanting to keep inflation in. It is going to be more concerned, though, with getting unemployment down. But unemployment is going to remain high for 3 or 4 years. But by the way, it's always been that way. In previous downturns, unemployment has remained high for a number of years, but the property market picked up long before unemployment went down. Now, I know that's counterintuitive. You'd think if people haven't got jobs and if people are insecure about their jobs, they wouldn't be buying property. But go back a couple of episodes of the Michael Yardney podcast when you'll hear me and Stuart Wayne speak about that. He's done some deep research, and as have others, showing that high unemployment levels in general are not going to affect the property markets. Certain segments of it will, and that's why if you are going to invest, you've got to use the same criteria we've always talked about. The fundamentals of where you buy, how you manage your cash flow haven't changed through all this. Now, clearly, some areas are going to suffer more, those that are more tourism related. So we never suggested that you invest in the Gold Coast or the Sunshine Coast or tourism related areas, including Hobart. Education is an area of the economy that's going to suffer, but again, we've always recommended you avoid buying in areas which are very dependent upon one type of tenant. So buying properties around universities or hospitals, or that's not the right place to invest. Of course, as I said, retail is going to suffer for a while. So if you're looking at commercial properties, and at Metropole we buy a lot of commercial properties for clients, I'd be a bit careful with the retail sector. But there's other areas that are going to prosper. The government's going to likely get a lot bigger, and the manufacturing is going to happen more in Australia. I hope that the government and businesses are going to start buying more locally than overseas. I think it's learned about that. Technology, defence, agriculture, infrastructure, all they are going to prosper as well. So a few more things I want to discuss with you, but just if I put all that together, what I'd like to do is maybe give you some recommendations at this stage. And the first one is, don't overact when you hear the bad news. Recessions are largely driven by how the population is feeling about the economy. In fact, it's more that than the economy itself, because how we feel and what we spend and what we do affects the economy. We know property investors tend to overreact. During booms, they'll buy anything and everything. And when there's bad news, they'll sit on the sidelines. And we're noticing that at Metropole, that there are a lot of very experienced investors, more than ever, actually approaching us for advice, for putting a strategic property plan together, for planning for the future. But a lot of beginning investors have stepped out. They're waiting at the moment to hear the good news. Instead, I'd be saying, next recommendation, think long term. Don't make 30-year investment decisions based on the last 30 days of news. Think 10 years down the road. If you really want to build significant wealth, think long term, outside the normal ups and downs of the economic cycle. The next recommendation, I've already said it, is don't try and time the market. You know that even the experts can't get that right. So will the market drop a little bit more? Yes. As I said, you're not buying the market. So you've got to buy in those market segments that are going to be more stable because of their location, because of the demographics in those locations, more affluent areas where people have got good jobs. Now, you may say, I can't afford those. You may not be able to buy a house, but buying an apartment in the right location, the flats, the old style flats or villa units, they may be the right thing for you. But before you do that, my next recommendation is make sure you have a solid financial foundation. Make sure you're looking after your cash flow. Make sure you've got the right finance strategies in place to buy yourself time, not just properties, to ride the ups and downs. Make sure you've got the right ownership structures to maximise your upside and protect your risks, to minimise your tax and pass on your wealth to future generations. Because we are getting to the point where, as we are let out of this lockdown, more and more people are going to be wanting to get on with their lives again. Auctions are occurring, open for inspections are occurring. The market is likely to pick up. But there's definitely going to be more bad news. There's going to be people telling you not to buy property. But interestingly, in all the years I've been investing, there have always been people telling me not to buy property. If you look back a decade ago, as we were working our way through the global financial crisis, there were quite a lot of commentators suggesting that property values just wouldn't increase in Australia for at least another decade. Well, they've been proven wrong, as owners of well-located properties in most of our capital cities and in many of our regional areas enjoyed substantial growth in value. Yet the property pessimists are out there again now, telling us how a major depression caused by the coronavirus pandemic is going to lead to real estate Armageddon. Now, I know at times their arguments seem to make sense. That's why I once again went through a number of reasons why I see the downturn we're in at the moment is going to be short-lived. So I don't just do it on speculation, but I invest based on evidence. I do listen to the news. I know one shouldn't, and so like you, I hear the bad news and the good news, but I'm careful where I listen. I'm careful who I listen to, and I'm careful whose opinions I pay attention to. Of course, I don't want to fall into confirmation bias where I just believe my own beliefs, and on that basis, I genuinely do look at other people's thoughts as well. But I'm careful again who I listen to, because if I didn't pay attention to the right people, if I guess I paid attention to the wrong people, I wouldn't be where I am today. I wouldn't have built the property portfolio I had today. As I said, there's always people who are going to tell you that property values are not going to go up. But think about it. What did your parents pay for their house? Who wouldn't want to buy their parents' home at the price their parents paid for it? In 1978, my parents paid $25,000 for their house, and they took out a 30-year bank loan to pay it off. About 20 years or so ago, my mother sold that house for more than $600,000. So $28,000, $600,000. And interestingly, she hadn't done much to improve it. It was a bit out of date and eventually it was pulled down. Today that property would be worth $2 million because of the location where it was, because the land had appreciated, because it was in a good middle ring suburb of Melbourne. Yet over the years, there'd been lots and lots of excuses why I wouldn't have invested, she wouldn't have invested, you wouldn't have invested. So let me have a look at some of the excuses I could have used over my investment career that if I had paid attention to them, I wouldn't be where I am today. In the early to mid-60s, we'd emerged out of a major credit squeeze. Now, I wasn't investing then, but I do remember the stories about a credit squeeze and finance had dried up and it made it hard for people to buy real estate. And I do remember, in fact, that sellers were selling on vendor terms. Sellers were giving finance because the banks wouldn't. Interesting times. I didn't have the money to do things then. In the late 1960s, I do remember there was a nickel share boom. I actually invested in stocks and shares. Not that I understood what I was doing. The end result was I made some money, I lost some money. I think I lost a bit in the end. It was pure speculation. But during that share boom in the late 60s, property was proclaimed as an inferior investment. Now, I started investing in the 70s, and in the mid-70s we had a recession in Australia. And then in the late 70s we were suffering from rising inflation and the OPEC oil crisis. I remember you actually could only buy properties on an odd or an even day depending upon what your number plate was. There was lots of things going on in Australia with a recession and around the world with all crises where people said don't invest. But I was dumb enough to keep investing. In 1983, we had a recession. There were really high interest rates, peaking inflation, and a few years later, commentators said property prices are just too high. They'd take years to recover. Again, I was dumb enough not to pay attention to them. Now, in 1985, the government changed the tax laws. They actually quarantined tax benefits of negative gearing, and they introduced capital gains tax. And again, at the time, people said that's the end of property investment as we knew it. No negative gearing and capital gains tax when you sell. Why would you ever bother buying property? Well, I kept doing it. In 1987, there was fears of a 1930s type depression because we had a severe Black Monday stock market crash. I even remember where I was actually on vacation in Sydney with a friend at the time when that 1987 stock market crash occurred. Interestingly, following that, we had a huge property boom. Now, of course, it led to significant inflation, which finally led to the recession we had to have as interest rates rose to well over double digits. And the properties, some of the properties I owned, commercial properties, went down in value. It was a heaven-sent excuse for procrastinators to stay out of the property market, which was awash with bargains because at that time the government didn't give the support that it's giving now, and banks did foreclose on a lot of properties in Melbourne and Victoria, where I was at the time and still am, I guess. I still remember in the late 80s there was the cry, our children will never be able to afford to enter the property market. Property prices just can't go higher. We've taken on too much debt. Don't invest in property. That was 30 years ago. Look what's happened to property values since. In 1991, unemployment was 11.3%. And I know some unfortunate owners chose to sell their houses, sell at the wrong time in the cycle, because they thought property values were only going to fall further, and that was the end of the property market in Australia. Look what's happened since. 93, 94, there was foreign debt and the current account deficit has scared off some people from buying property. We had an Asian financial crisis and a world economic slowdown in the middle 1990s. Again, the doomsayers were out saying, don't invest in property. In the mid-90s, we had inflation, which was actually very low at the time. And we were told, hey, property values won't rise, but they went up, they went down. We had our cyclical property markets, and if you took a short-term view, yes, you would have stayed out of the property market, but if you would have taken a long-term view, boy, would you have made money if you were fearful when others were greedy and didn't get carried away in the booms, and greedy when others were fearful. Like sort of happening now. The reason I'm going through this with you is to tell you there's been so many potential reasons I shouldn't have invested. But all I did was I bought well-located investment-grade properties, and as the values increased and my cash flow allowed, I'd buy another one and another one, not paying too much attention to what was going on in the cycle, just knowing that I wanted to build a substantial asset base to give me the choices that I now enjoy. There was, in September 11th, in the early 2000s, would have been a great excuse not to invest in the rising oil prices. In 2001, we introduced GST in Australia, and there was a potential reason. It was not to invest. It was predicted it would put a huge damper on property values because all new properties suddenly had GST on them. In other words, all new apartments, all new houses, 10% more in value. Whatever it cost before, now an extra 10%. Hey, that would be unsustainable, wouldn't it? Well, that's what people said. Hasn't made a difference, has it? There was a property slump in 2004, 2006. We had the global financial crisis in 2008, 2009, 2011, 12. Many thought the world's financial markets would collapse due to the economic troubles in the United States and in Europe. In 2016, the world's economy was faltering, in part due to China's slowing economy and falling commodity prices. And of course, in 2018-19, property values in Melbourne and Sydney had their biggest fall in modern history, slipping 15% in Sydney, 11% in Melbourne. But that was after growing 70% in Sydney, 50% in Melbourne over the previous 5 years. So boy, were there lots of reasons not to invest in real estate. Yet through those times, the almost 50 years I've been investing, the value of well-located residential real estate has increased consistently at around 7% per annum. Now, not every year, and not all properties. So there were periods in the Melbourne property market when it didn't do well and Brisbane did well. There were early part of the 2000s where the Sydney property market didn't do anything at all. So it's important to get a level of diversification once you start to get a portfolio of properties, so that if Melbourne isn't doing well for a few years, your Sydney properties will do well or your Brisbane properties do well. Diversification is the topic of another podcast. But all I'm saying is I'm not suggesting that property values will go up every year at 7%, but our statistics at Metropole, and Kate Forbes, one of my co-directors, has got statistics for every state, every suburb, houses, apartments, going back to September 1980. And I can tell you that Melbourne and Sydney apartments and houses have done better than 7% per annum on average. Brisbane just a little bit lower than that. In other words, on average, properties doubled every 10 years, which means some did much better than that and a whole lot didn't. So don't take that as a reason just to invest in any property, but I'm talking about the asset class. Remember, I bought my first property for $18,000. It would be worth probably about $1.5 million today if I hadn't pulled it down and built 2 townhouses on the land that combined are worth over $2.5 million. $18,000. I went halves in with my parents. I couldn't afford to pay for it all. I took a 30-year loan on that $18,000. Remember, I got $12 a week rent for my first investment, and I was excited. But over the years, the rent for my properties have helped pay the mortgages. The capital growth has allowed me to borrow against the increasing value and pyramid myself into other property investments. In fact, I've built my very substantial multi-million-dollar property portfolio with my initial $2,000 deposit. And I haven't put that much of my own money into the portfolio because it's come from the appreciating asset value. It's come from the compounding capital growth. So what's ahead? Sure, there are some headwinds facing us, and I do see future capital growth more subdued over the next few years. But I believe if we look back in 10 years' time, we're going to have a really good decade, just like the last decade has been and the one before. But the reason I went through all those excuses for not investing with you a minute ago was to show you that in every 10-year period, there were good things happening, but there was always 2 or 3 bad big things that we could have used as an excuse not to invest. It'll be the same in the coming decade. I've heard it said that if you want to know what lies ahead, start by looking at clues behind you. If you think about it, as I said, lots happened in that last decade. I mean, if you came back today from overseas, and you can't travel to Australia now, but if you could and you came back, you wouldn't recognise the skyline and the impact of the high-rise buildings and the city apartment developments. In Melbourne, there's Docklands. In Perth, the Golden Mile on the drive from the airport. In Sydney and Brisbane, the landscapes are now peppered with inner city apartments. As well, many of the old houses in our suburban streets have made way for modern townhouses and apartments, and there's going to be significant changes to our property landscape moving ahead over the next decade as we move to close to 29 million people from the 25.5 we have now. We've got to accommodate them somewhere. And as this happens, our property markets are going to be underpinned by this strong population growth and the general wealth of our nation. And those who take the opportunity to buy well-located residential real estate during the current uncertain times are likely to look back in a decade's time and say, hey, gee, I made a great decision. Now, I don't know your personal situation, but I do know that if you have got a secure job and firm finances, it's the time that you should be setting yourself up for the opportunities that are going to present themselves as the market moves on. But if you're not sure, is it right, shouldn't it, when, how, why not have a chat with my team at Metropole? Because we will help you with direction, we'll help you with guidance, we'll help you get wealth-producing results. You see, in challenging times like this, you need an advisor, team of advisors who takes a holistic approach to your wealth creation, and that's exactly what you get from my multi-award winning team at Metropole. You see, there's a lot of people like me in that team who've been around the block a few times and understand what's going on, and our deep research gives all our advisors the opportunity to pass that information on to you. let me remind you, we don't sell any properties at Metropole. Why not go to metropole.com.au, find out about how we can help you, leave your details, metropole.com.au, or give us a call, 1300 Metropole. Hey, there'll be a link in the show note. And when you have a look at what we do, you'll find out that whether you're wanting to buy your next home or your investment property, we give strategic advice. We put together strategic property plans. We have a buyer's agency that's been involved in over $3.5 billion worth of property transactions. Hey, we've won 3 awards in the last 18 months as Australia's leading property consultants. I'm really proud of what our team's achieved. We've got a wealth advisory service run by Ken Race to give strategic, tailored financial planning and wealth advice, property management, property renovations, property development. If you want to know how to invest in uncertain times, get the direction you need from my team at Metropole. In my mindset message today, I'm going to have a chat with the co-author of my best-selling book, Rich Habits, Poor Habits, Tom Corley, about how we're hardwired in a particular way that may not be as productive as you'd expect nature to be to us.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
I recently sent an email to my database asking what topics you'd like me to discuss on my podcast, and clearly the psychology of success, the mindset of successful property investors, entrepreneurs and business people was very, very high on the list, and that's why each week we have Michael's Mindset Moment. This is a slightly longer moment session though, because I've got a special guest from the United States, the co-author of my top-selling book, Rich Habits, Poor Habits, and I caught up with him a couple of weeks ago in a conversation about a blog that took me by surprise. So here's what we talked about. Welcome, Tom Corley.
It's good to be back, Michael.
Now, Tom, I read something that you wrote a short while ago that was pretty controversial, and I'd like to get some better understanding of it. Because what I read from you was that your suggestion was we're all hardwired to be miserable. Now, that was a bit of a punch in the gut, but I think you said a psychology professor did a study and said we're hardwired for unhappiness. What's all this about?
Yeah, so this kind of caught me off guard, but once I read through the study, David Buss, who's a professor of psychology with the University of Texas, so he had this study where he was looking at unhappiness, people who are unhappy in general. And what he found was, through his background in psychology and neurology, was that we are hardwired, meaning we are born to be miserable and unhappy. Now, you might say, well, that I disagree with that. Well, before you say that, let me explain why we are born that way. We happen to be the most successful species on the planet. One of the reasons we're the most successful species on the planet is because we're always striving to improve and to better ourselves. We have this itch, that's this scratch that we just can't scratch enough, and it's unhappiness. Our brains are hardwired to put us in a state of constant agitation. We have these moments of happiness, and here's an important point. They're moments, because through evolution, I guess the human fabric, the way that it is, evolution realized, hey, if we as human beings are going to be successful, we can't be happy all the time, because if we are happy all the time, we're going to stop trying. We're going to become complacent. So once we achieve something that makes us happy, it's this most unfair act of evolution, but it pushes our happiness away and reverts us back to our happiness baseline, which is really unhappiness. So now we're unhappy after we bought this beautiful car that we've owned for about 2 months. Now it's just a car to us. Or we bought this beautiful real estate on the coastline in Brisbane there. And after a couple months, well, it's just another piece of property that we own. That's just the way our brains work. We're hardwired to revert back to our happiness baseline, or to a level of what I call misery, constant misery. And that's a good thing, because then we're going to look for something else that will help us become happier. And that's usually something that forces us to grow and expand and to achieve.
That's interesting, Tom. I hadn't realised that before until you brought this up. So really, if we were always happy and comfortable, we'd pack up our tents and stop trying to improve. But being hardwired for unhappiness is why we compete, why we chase dreams, why we go to college, why we want to start a new business, why we're prepared to sacrifice something to get a better future. And that's actually, I guess, something that's unique to humans compared to other species. It drives us to the next level.
Yeah, I mean, it's actually, if you think about it, it's probably a blessing in disguise because, we're all chasing moments of happiness, and they truly are moments. When you work, like I've been working really hard for the last, 6 years trying to promote my books and trying to get the word out on my research, it's mostly feels like I'm pushing a ball uphill. And it's like 90% unhappiness because it's work, it's hard, and I never really get the satisfaction out of it except that 10% of the time. But Michael, that 10% of the time, it makes it all worthwhile. And I think that's the secret sauce. That's the secret in the sauce, is that these moments of happiness, well, they're so uplifting that when the happiness goes away, what's left behind is a feeling of unhappiness because we're not happy. When you're not happy, you're unhappy. So you chase happiness events. And some of those happiness events are things like starting a business, hitting a sales goal, getting that quarterly bonus, or whatever. So this unhappiness baseline forces us to be more than we would otherwise be.
So the bottom line is, if you're unhappy with your life, there's a good reason. Life's screaming at you to grow. Life's telling you to improve. So if you want to become a better human being, it's time to listen to that inner voice. Well, clearly we're living in interesting times, and I hope today our chat has helped give you a little bit more clarity on what's ahead. I'll, of course, be back twice a week with the Michael Yardney podcast. Sometimes there'll be long monologues like this, and probably half the time they're going to be with the various guests that I bring on to help give a diversity of opinions to help you move forward as we move out of the coronavirus cocoon and into what's a more normal life. Now, if you got some benefit from today, please help me in my quest to make as many people as possible financially literate by telling somebody about the show. There's a share button on all the podcast apps, or leave a review on iTunes, Stitcher, Google Play, wherever you listen to this. I'll be back twice a week, as I said, but in between you can catch me on social media or my daily property update newsletter. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?